Managing Principal of MBAF's 2 New York offices, and I'm also a tax principal specializing in corporate reorganizations, accounting methods, and pass-through entities. On behalf of the entire MBAF team, I would like to welcome everyone listening in to MBAF's 2019 Tax Planning Webinar, and a special thank you and welcome to our clients and friends. Joining me today are 3 of my partners, Mike Farah, Gretel Anasagasti, and Gary Duboff. Mike is located in our downtown Miami office and is the chairman of MBAF's tax department. Mike specializes in international tax and corporate restructuring, tax planning for real estate developers and investors, and income and estate planning for high net worth individuals. Gretel is located in our Coral Gables office. Gretel specializes in tax planning for pass-through entities, particularly complex partnership transactions involving commercial and residential real estate, as well as retail and wholesale distribution businesses and closely held business entities. Gary is located in our New York City office. Gary specializes in family office services for high net worth individuals, families, corporate executives, and closely held business owners. He has extensive experience advising clients with personal and business tax issues, investment and financial planning, family wealth transfer, and estate and retirement planning, as well as charitable giving. Let me take a moment to introduce today's agenda. Mike is going to cover planning ideas related to qualified business income deductions and qualified opportunity zones. Gretel will be reviewing the rules and planning opportunities regarding bonus depreciation and business interest expense deduction limitation. Gary will cover some interesting planning ideas for high net worth individuals and estates and trusts. And Mike will wrap up the program with a quick overview of international tax rules and planning opportunities. Time permitting, we will address some of your questions at the end of the program. Please submit your questions throughout the webinar, and we will try to address them as we go along. Before turning it over to Mike, a couple of quick administrative points. Today's webinar qualifies for CPE. We'll be asking 3 polling questions throughout the presentation, so please be on the lookout for those polling questions. To submit questions, please click on the control panel located on the right side of your screen. There you will see a tab titled Questions. The slides from today's webinar are available for download at the tab titled Handouts, also on the control panel. We would really appreciate your feedback, so please take a moment and fill out the survey that you will be receiving. And finally, at the end of the presentation, there's a link to MBAF's 2019 Year-End Tax Planning Guide. And now I will turn it over to Mike.
Thank you, Emilio. Good morning, everyone. The Tax Cuts and Jobs Act, passed in December 2017, really focused on tax savings for operating businesses. The main focus really was to reduce the tax rate on businesses, corporations, C corporations. The tax rate got reduced to 21%. And since there are a lot of flow-through entities, pass-through entities that are big operating businesses, in order to reduce their tax rate also to a comparable level, the concept of qualified business income was established. If you have QBI, qualified business income, your effective tax rate could go down to down to 29.6%. There's the differential in the rates is that, as you know, C corporations are subject to a double tax when a dividend is paid, whereas flow-through entities, there is no double tax. Distributions made by a S corporation or partnership are basically tax-free. In order to go, and during 2018, these rules were implemented, and we did see major tax savings for our clients that made millions of dollars basically saved millions of dollars in tax, and clients that made hundreds of thousands of dollars saved thousands of dollars of tax also. And we're very careful in trying to apply and make sure that everybody that was entitled to the QBI deduction received it. In order to get the QBI deduction, you have to meet certain parameters. First, the deduction is 20% of the taxpayer's share of qualified business income, but it's limited to 50% of the W-2 wages that is attributable to a qualified trade or business, or in case of major real estate holdings, you can utilize a different formula, which is 25% of the W-2 wages plus 2.5% of the unadjusted basis of the property immediately after the acquisition. I guess this was put into law to benefit those that are, as opposed to operating businesses, those businesses which are big major real estate holdings in rental properties and so forth, to be able to take advantage of this. Currently, this law is effective through December 31st, 2025. That is when it sunsets. Since the taxable income of taxpayers, if you're single, 210,000, and married up to $421,000, their tax rate basically is in the 28% bracket. This QBI deduction does not apply to them. Now, the issue that we found is what is really qualified business income? Generally, it's income effectively connected with a trade or business in the United States. If you have a trade or business outside of the United States, which you did a check the box election to treat it as a flow through entity, that does not qualify, but only trades or businesses in the United States. Now, it does not include passive type of activities such as interest income, dividend income, investment activities such as that. And we also found out that guaranteed payments do not qualify for QBI, and I'll get into that a little bit later also. Service businesses basically were excluded from the definition of qualified business income, and the regulations provided a definition for what trades or businesses are, and they just specified service trades or businesses, and those are any trade or businesses involving the performance of service in the fields of health, law, accounting, actuarial sciences, financial services, consulting, and so forth. Before the law passed, since we do have a lot of major healthcare clients that are major operating businesses, we did speak to some of the congressmen to discuss why they were excluded from that. In addition to that, we have a lot of major law firms and accounting firms as ours, which were excluded from the definition. And they all felt that since service, trades, or businesses are allowed to be on the cash basis of accounting, that they should not get an additional benefit from it. Even though these trades or businesses do employ thousands of people, have millions of dollars in plant and equipment and so forth, they were excluded from there. However, engineers, architects, and real estate brokers are not specified service trades or businesses, so therefore they do qualify for the QBI deduction. Apparently, those lobby groups were successful in doing that. They differentiated those services from the QBI, I guess because they're building something and real estate brokers are selling a product as opposed to something that's intangible. A new form came out this year to help you compute the qualified business income deduction. It's form 8995. It's in draft form. I mentioned this for the practitioners that are out there. However, last year when our returns were prepared, the software that we used really did an excellent job in doing the computation of QBI and offsetting losses against income and really presenting a good report that was attached to the return. As far as specified service trade or business are concerned, there's a de minimis rule. If the entity has income of less than $26 million and 10% or less of the income is a service, it is excluded from being a service business, or 5% in the case of gross receipts of more than $26 million. Now, a company can have multiple trades or businesses within the entity. So if you keep separate books and records and you're able to identify various areas of the company, those different areas could be deemed to be subject to the QBI deduction and some not to the QBI deduction. So it's very important to keep good books and records in that regards. There was always a concern over whether triple net leases qualify for QBI. So if a taxpayer has one triple net lease, it really doesn't rise to the level of a qualified trade or business. But if a client does have various triple net leases, and that is what he's engaged in the business of doing, those would rise to the level of qualified business income. Director's fees and trustee fees. Of course, if you're a professional fiduciary company or a professional trust company, that does qualify. Whereas, a person that serves as a director on a board would not qualify for that. Now, the regulations came out with something that was very advantageous to our clients, which is the concept of aggregating trades or businesses for purposes of computing the QBI deduction. An example of that is sometimes a client has various companies that are separate for legal purposes, and then there's one company that has the payroll. Well, since the payroll factor is a major consideration in computing QBI, we were concerned that you were not able to take that payroll company in consideration to computing the QBI deduction in the whole group. But the IRS clarified that, and they basically said that trades or businesses that have certain similarity can be integrated. And if they demonstrate that the businesses are in fact part of a larger business, you can go ahead and aggregate. They basically came out with 3 factors that if you meet 2 of them, it qualifies. One of them is that the business provided product and services that are the same. An example that they provide in the regulations is a restaurant and a food truck. We don't have any food trucks as clients. However, I would guess a restaurant and a hotel would be the same, or that they provide product or services that are customary provided together. Example, gas station and car wash. Businesses that share facilities or share significant centralized business elements is very common. For example, if they have common personnel, centralized accounting unit, centralized legal unit, human resources, and even those may be in separate corporations, those entities can be aggregated for purposes of computing the QBI. And businesses that are operating in coordination with or reliance on other businesses in the aggregated group. And the example that provides supply chain interdependencies, so that can be aggregated. We did discover certain traps that are within the law during the course of the year, and one of those is in the partnership area, which are guaranteed payments. As you know, a partner in a partnership cannot take salary compensation, W-2 wages. However, a partner can be compensated via a guaranteed payment, and the guaranteed payment is a deduction at the partnership level, which reduces the partnership taxable income, and it's ordinary income to the partner that receives it. However, for purposes of computing the QBI, the qualified business income deduction, you cannot take the guaranteed payments as if there were W-2 wages for purposes of you meeting the limitation of the QBI deduction. In situations like that, we have tried to eliminate the guaranteed payment and separate the payment into a separate entity, an S corporation that handles payrolls for various members of the group, and therefore those wages would be taken into consideration in doing the QBI computation. So when Congress, when the president really wanted to stimulate businesses and give a big tax break to operating businesses, he certainly did it through the QBI deduction, and of course through the reduction of the 21% tax rate. And I think they were the major benefactors of the tax reform. Now, moving on to qualified opportunity zones, another provision of the Tax Reform Act that really has become very hot and very interesting here in South Florida, though we have seen a lot of clients, several clients invest in qualified opportunity zone properties, is this concept of the qualified opportunity zones and qualified opportunity fund. Basically, if a client has a capital gain, a realized capital gain, and the capital gain does not have to be associated with real estate. It may be a capital gain from the sale of stocks or bonds. It could be a capital gain associated from the sale of your home, a sale of art. That capital gain, if invested within 180 days in a qualified opportunity property or a qualified opportunity fund, it gives you deferral of the capital gain. Now, if you are investing in an actual property, then you have to substantially improve the property. What that means that is that, for example, if you purchase a property for $2 million, you just need to substantially improve it by putting in $2 million worth of improvements into that property. If you find something that is in a qualified opportunity area, and the qualified opportunity area is basically authority were given to the governors of various states to designate areas within their state as qualified opportunity zone areas. In Miami, you have the areas of Alapadas, somewhat South Miami, Cutler Bay, and so forth. Up in the Northeast, Long Island City, various areas of Long Island cities are qualified opportunity zones. If you look at the maps, Puerto Rico, most of Puerto Rico is a qualified opportunity zone. So if it fits the client to do this, it's a great tax savings. First, the benefits are you defer payment of the capital gain. However, in the year 2026, you do pay the capital gains, but you only pay tax on 85% of the capital gain. 15% of that gain goes away tax-free. Any future appreciation of the property, and if you sell the property, you hold the property for 10 years, longer than 10 years, and you sell it after 10 years, any future appreciation of the property, and when you sell it, is also tax-free. So for example, if you did a qualified opportunity zone property, you bought it for 2 million, you substantially improved it for another 2 million, your total cost is 4. If after 10 years you sell it for 10, that $6 million gain is tax-free if you sell it after 10 years. So that is a substantial benefit from these. And from a business point of view, seeing what has happened in Miami and the growth that Miami has had, that it is expanding to different areas. This area of Alapara has grown tremendously, and you see investments that are happening there, and the growth is naturally evolving to that. So people that do invest in these zones, and these zones are refurbished, could be a major profit center. Of course, like everything that the IRS puts out, there are qualifications in order to do this. One, annually, you have to self-certify that you, with your tax return by filing the Form 8996, that you still qualify for the Qualified Opportunity Zone benefits. One of those requirements is that the company invest and hold at least 90% of its assets in Qualified Opportunity Zone property. And of course, you know, you had to invest within 180 days and of realizing the gain. Now, choice of entity is very important in doing these. If you decide to do the qualified opportunity zone on your own, there are clients, there are people that have started qualified opportunity funds, which basically is the easiest way of investing, that you give your money to these funds and they comply with the rules, and you get the benefit accordingly. I don't know whether your return on investment will be as good as if you did something on your own, but if you do decide to do something on your own, which is what most of our clients have done, choice of entity is important, whether you choose to do it in partnership format or corporation. The lure has been to do corporations for some people because they believe over the 21% tax rate. However, we recommend mostly flow-through entities and partnerships because of the flexibility that a partnership gives you in making distributions of profits or distributions when you refinance. So a partnership is better, is better to do it. Always, please consult with your accountants or your tax advisors regarding setting up a qualified opportunity zone business, because of the technicalities as associated with it, and make sure that your operative agreements, your operating agreement, and so forth are in compliance also. One thing to be careful is that some states do not recognize this qualified opportunity zones. So there's not conformity in all the states. Florida does conform, New York does conform, New Jersey does conform. So a lot of them do. And the last major important factor is that if you do it on your own, it has to be an active trade or business. It cannot be something passive. Now, owning a rental property is an active trade or business. If you do this as a warehouse for your company, of course, that's an active trade or business. So it has to be an active trade or business that that you're doing this. Um, uh, you always have the potential also when you do the qualified opportunity zone is taking benefits of the new market tax credit and the low income housing credits. That is also allowed. And when you do this, consider the difference in doing the investment in a qualified opportunity zone investment or doing a like and exchange. The difference basically is in a like and exchange, yes, you have, if you do it correctly, you have 100% deferral until you sell the like and exchange property, although many clients keep rolling over into a like and exchange, but there will be a day of reckoning. But the qualified opportunity zone does give you a reduction in tax. It doesn't give you permanent deferral, but it gives you one on the gain that you reinvested. On a like and exchange, you really have to invest all the proceeds that you received from the sale. In a qualified opportunity zone, you invest only the capital gain that you realize. So you're investing less. However, that capital gain, you will pay tax on it by the year 2026 and 85% of it. But hey, future appreciation is tax-free. That's a major consideration. So if the opportunity is there and everything fits and you find a property in a qualified opportunity zone area that fits your business interest, it's something to consider and move forward with. Yes, avoid land banking. Just buying land and holding it does not meet the qualified opportunity zone test. So Emilio,
Thank you, Mike.
I want to turn it over back to you now.
Okay, great. This brings us up to our first polling question. And the question is, the question is, what is the new IRS form that covers the qualified business deduction? And while we wait for you to fill out your answers, Mike, a question came in on whether a CPA, attorney, or doctor would qualify for the QBI deduction if they file Schedule C for their respective business.
No.
In general, no, but depends what their level of income is.
Generally no, but if depending on the level of business, if the level of business falls below
The thresholds.
below the threshold, then basically they would qualify.
All right, a few more seconds for the polls. And here are the results of the poll. And most of us got it right. It is new Form 8995. So with that, let me turn it over to Gretel. Gretel, why don't you take us through the new depreciation and interest expense rules?
Thank you, Emilio. As most of you know, one of the most commonly used and effective year-end tax planning techniques is to find ways to defer income into the following year and accelerate deductions into the current year. Although this year with a new tax act, this may not always be the best strategy, but we'll talk about that later. As far as accelerating deductions, depreciation has always been one of the most flexible and advantageous techniques. This year, this has become even more so with the enactment of the 100% bonus depreciation deduction. See, the new tax act increased the bonus depreciation from 50% to 100% for assets placed in service after September 27th of 2017, which means businesses can now write off 100% of the cost of any furniture, computer equipment, machinery, etc., at the time these assets placed in service. So if you can place those assets in service by December 31st of this year, you will be able to write off 100% of them. Now, in addition to this, the new tax act was enhanced to allow for bonus depreciation on previously used assets. In the past, only brand new assets were eligible for bonus. This change can be dramatic for taxpayers in certain industries in which the purchase of used machinery or equipment is commonplace. It's important to know, however, that the bonus depreciation cannot be taken on previously used property if the property was transferred from a related party. This prevents the potential abuse of transferring property currently being depreciated as a way to achieve 100% write-off. For example, an entity may have placed in service furniture on 1/1/17 and still has at least 5 years of depreciation to go on it. It is tempting to have that furniture transferred over to a related party and have this related party get to write it off 100% via bonus depreciation. So the IRS placed that related party restriction to prevent this. Now, as beneficial as these changes have been, there was one very painful part that came about in the drafting of the Tax Cuts and Jobs Act, and that was the technical error regarding qualified improvement property. The new act actually created a new category of depreciable property known as qualified improvement property, or QIP, which includes not only leasehold improvements and qualified retail property as used to be the case, but now it includes any kind of improvement made to the interior part of a non-residential building. This is huge because it means that any improvement you do to your office space, as long as it's not deemed to be structural in nature, will be covered under this new category, which was intended to be depreciated over 15 years and eligible for bonus depreciation. However, the enacted Tax Act had a technical drafting error, commonly referred to as the retail glitch, in which it actually excluded QIP, or qualified improvement property, from the 15-year classification. As a result of this, now all qualified improvement property is depreciable over 39 years instead of 15 years. So not only does this affect the depreciation deduction, but the 39-year classification also precludes it from being eligible for bonus depreciation. This means that not only did this error affect a new category of property, but it actually eliminated the shorter recovery life for property that had previously been subject to this 15-year class life. Unfortunately, congressional efforts to correct this mistake have gone nowhere, and most of us tax practitioners were very disappointed to see that the final regulations issued in earlier September of this year did not address this necessary correction. Until Congress issues this technical correction, qualified improvement property will continue to be depreciable over the longer recovery period and cannot take bonus depreciation. As you can imagine, this has become a significant issue for tax planning for several different reasons, including the new business interest expense limitations, which actually is a great segue into the next category that we will be discussing. So, business interest expense deductions under Code Section 163J. Starting in 2018, 163J was revised to include a new limitation of interest deduction that used to be available to many businesses. Essentially, the new 163J rules limit the interest expense deduction to the sum of 1, business interest income, 2, 30% of adjusted taxable income, or ATI, and 3, floor plan financing interest, which applies to auto dealers and farm machinery or equipment. Now, for purposes of the 163J rules, business interest income means the amount of interest includable in the taxpayer's gross income allocable to a trade or business. It does not include investment interest income. So if a business has an investment account or a brokerage account that yields interest, that is not considered for purposes of this computation. However, interest income from trade receivables and interest-bearing accounts do count. The next important definition is adjusted taxable income, or ATI. ATI is computed by starting with a taxable income or loss for the year without regard for business interest income, business interest expense, depreciation and amortization, but only for years until 2021. After 2021, ATI will be net of depreciation and amortization deductions. And it also does not include net operating losses or any items of income, gains, deductions or losses not allocable to a trade or business. The third item in the computation is floor plan finance interest, which is applicable to very specific industries, so we can put that aside for now. Now, I think the easiest way to understand how this computation works is by going through an example. So here we have ABC LLC that has the following activity. Has gross receipts of 27 million and cost of sales of 26.9, leaving it with a gross profit of 100,000. It earned business interest income of 5,000 and it had business interest expense of 40,000 and depreciation of 10. So it ended the year with a net income of 55,000. So how to compute what amount of that 40,000 interest expense is deductible is you have to go through the classifications. The first category is you can deduct business interest expense to the extent that you have business interest income. So right off the bat, you know that the entity had $5,000 of business interest income. So that's number one, you know that automatically you will be able to deduct at least 5,000. Now the next section comes 30% of ATI. How do you compute ATI in this example? You start with the taxable income of 55,000. You add back depreciation of 10. You add back interest expense of 40, and you back out the interest income of 5, leaving you with ATI of 100,000. So you are entitled to take 30% of that ATI or $30,000. Again, ignoring the third category of floor plan financing interest, this means that in our particular example, ABC LLC can deduct $35,000 of the business interest expense that it incurred. The remaining $5,000 will be suspended until a business generates sufficient income in subsequent years to free up the suspended interest expense. Now, the 163J rules do provide some provisions accepting certain businesses or individuals from the interest expense limitations. One of the most significant of these exceptions is for small business taxpayers. Essentially, this exception provides that businesses with average gross receipts that do not exceed 26 million for 2019, and that 26 million is indexed for inflation. It used to be 25 million in 2018. But if gross receipts do not exceed 26 million for the prior 3 years, the entity will be considered a small business and will not be subject to the interest expense limitations. So this is a great exception that's out there. Now, in order to qualify under the gross receipts rules, all entities under common control that are treated as a single employer for IRS purposes must be grouped in. This is to prevent entities from splitting up businesses in order to fall under the gross receipts threshold. For example, if you have a business that makes $30 million of gross receipts, it may be tempted to split the entity into 2 separate businesses, each making 15 million, and say, hey, we're eligible for this small business exception. So the gross receipt rules prevent this. And the rules for determining which entities have to be aggregated are very complex and certainly beyond the scope of this presentation. But if any of you have questions or would like to discuss this further, please reach out to us and we can meet after. Now, when it comes to the small business exception, one of the most important restrictions is buried in the definitions. See, for purposes of the 163J rules, an entity cannot be considered a small business if it's a tax shelter. And usually, if you hear the words tax shelter, you would think it applies to very, very limited entities, but that's not really the case. A tax shelter for this purpose is defined as an entity that allocates more than 35% of losses to limited partners or limited entrepreneurs. Okay, so if we go back to our example on ABC LLC, if that entity had, let's say, 25 million or 24 million of gross receipts and nothing else changes, okay, that entity would be considered a small business and would not be subject to the interest expense rules. So the entire 40,000 of interest earned would be deductible. Now, taking it a step further, if that entity had additional expenses and it actually ends the year with a small loss instead of the $55,000 of income. If it instead of that, it has a taxable loss and it's owned more than 35% by limited investors, then all of a sudden that entity, ABC LLC, would be considered a tax shelter and the 163J rules would apply. Even if it only had $1 million of gross receipts, it'll still be in there because it's considered a tax shelter. So as you can see, there are a lot of factors to consider depending on each business's circumstances. Another exception that's available is specifically for real property trades or businesses. And basically, real property trades or businesses are able to make an election to have the 163J rules not apply to them. They can make an election to be treated as an accepted business. And an entity that makes this election will never be subject to the 163J rules and can deduct 100% of the interest expense regardless of receipts or ATI or any of that. However, there is a cost to make the election, and that is that the entity has to switch to an ADS depreciation system, an alternative depreciation system. And this convention has some differences. For example, non-residential real estate is depreciated over 40 years instead of 39 years. Residential real estate purchased before 2018 is depreciated over 40 years instead of 27 and a half years. And residential real estate purchased on or after 2018 is depreciated over 30 years instead of 27 and a half years. Now, the longer recovery life is generally not a significant problem. However, the ADS system of depreciation does not allow for bonus depreciation. So, as we discussed previously, if Congress does make that anticipated technical correction to qualified improvement property, an entity that has made the real property trade or business election will never be able to take advantage of that accelerated bonus depreciation. It's also important to note that the election is irrevocable. So careful consideration must be taken before deciding whether or not to make this election. Okay, so now for the part that most of you are really here for. Now that we've gone through the basic concepts, what are some tax planning opportunities? Well, if an entity has the potential to be negatively impacted by the interest expense limitations, year-end tax planning may be an indispensable tool. Okay, for example, if an entity that is treated as a partnership needs to borrow funds and has the ability to do so from a friendly or a related party, it may want to consider structuring the cash inflow not as a loan, but rather granting to that funding individual or an entity, granting them a preferred capital interest in the partnership. This means the person funding will become a member of the partnership, or if they're already a member, they would receive a new class of interest. The partnership would then allocate to them preferred returns equivalent to the interest income that they would have been entitled to had the transaction been structured as a loan. By structuring this way, the entity will not have interest expense. It only has an allocation of the profits. Therefore, it's not subject to the 163J limitations. Everyone basically ends up in the same boat that they would have been had it been structured as a loan, but you do get out of the 163J regime, which is great. Now, it's important to note that for this to work, the preferred returns issued to the funding member cannot be guaranteed. Very important, because if they are guaranteed, they're going to be treated as guaranteed payments and they will be recharacterized as interest, and therefore it'll kick you right back into the 163J regime. Therefore, this type of structure does carry an element of risk, especially to the funding member, because they will only receive a preferred return to the extent that the entity generates sufficient income. But if you have an entity where there's no concern that the entity will have the ability to make these allocations, then this is something that should certainly be looked at closely as an alternative. Another tax planning opportunity, which may be helpful in some specific instances, has to do with a way to get out of the tax shelter regime. So businesses with average gross receipts of less than 26 million, who are owned 35% or more by limited entrepreneurs, and who expect to end the year with a small tax loss, but close to break even, may want to consider a reverse quote-unquote tax planning technique. In other words, businesses that would be eligible for the small business exception, if it were not for the fact that they were in a loss position, can try to accelerate income and defer deductions, hence the reverse tax planning, to the extent possible if it means that at the end of the year, the entity would end the year with profits instead of losses. Why? Because if an entity is profitable, it can qualify for the small business exception, even if it is owned by limited investors, and be exempt from the 163J rules and be able to deduct 100% of the interest expense. So, while both of these tax planning opportunities are limited to very specific situations, I think it's important to mention because it shows the importance of year-end planning and the fact that there is no one-size-fits-all when it comes to tax planning.
Thank you, Gretel. Before launching our second polling question, Gretel, I have a couple comments where we've seen some significant benefits from the new depreciation rules is in M&A deals that have been structured as purchase of assets, wherein the acquirer is now able to immediately expense the amount allocated to the fixed assets, via the purchase of the entire business's assets. And before they were considered used property and they'd have to depreciate them, over time, but now they get to immediately expense those expenditures.
Absolutely, Emilio. That's a great point, and it's definitely caused some tension between buyers and sellers. In the past, when you were structuring a transaction, a sale of assets, you would basically allocate net book value to these fixed assets and everyone was happy. Now you have a situation where the buyers want to allocate as much as possible to the fixed assets, and the sellers, for reasons definitely beyond the scope of this presentation, generally don't want to allocate that much to these fixed assets. They want to allocate to goodwill. So it has caused some tension in those type of structures. That's a
Okay,
great point.
let's launch the second polling question. Are you considering or have considered acquiring machinery and equipment before the end of the year to take advantage of the 100% bonus depreciation rules? And while we wait for the answers, the other note I had here, Gretel, was that given that one of the business incentives of the 17th Tax Act was encouraging businesses to make investments in machinery, equipment, et cetera, but at the same time, the law is curtailing these purchases via the use of debt with the new interest expense limitation rules.
Yeah, Emilio, that's somewhat of a conflicting message. I think there was definitely a focus on promoting investment in fixed assets while still retaining the effect of the interest expense limitation rules under 163J. So with the new 163J rules, Congress was able to identify a source for raising revenues, certainly, to offset this overall reduction on the tax rates.
All right, and here are polling results. 47% are considering or are making plans to make last minute purchase of assets before the end of the year. And speaking of reduction in tax rates, Gary has a couple of interesting opening slides on that topic. Gary?
Thank you, Emilio. I thought it would be beneficial for our listeners to refresh their collective memories on the major changes that impacted individuals through tax reform, starting with the changes in the tax rate schedules. The first table I'm sharing with you summarizes the pertinent information for single taxpayers. If you look at the table to the right, and I draw your attention to the columns on the right, you'll see that all of the rates were essentially different, with the exception of two tax brackets, the lowest and the 35% tax bracket. Note that at the bottom, the highest tax bracket, and one of the major changes in tax reform was the reduction of tax rates from 39.6% to 37%. If you move to the left and see the tax brackets themselves based on taxable income between 2017 and 19, you'll see that the brackets were actually expanded so that the highest bracket comes at $510,000 rather than $418,000. So there's a $100,000 differential. But if you really go through the numbers and calculate what the tax would be in 2017 on those tax brackets all the way up to 418 and the ones on 2019, you'll find out that the average effective rate is 28% for both 2017 and 19 up into the highest tax brackets. It's every marginal dollar after those highest tax brackets, where you'll see that the rates are 39.6 in 17 and 37% in 19. So those high income taxpayers, generally speaking, will have a lower tax rate based on the tax table. If you go to the next slide, you'll see the same data for married filing jointly, and you'll note that the highest tax bracket for 2019 is $612,000 versus $470 under the old table. Again, the same effective rate on the first 7 tax brackets in terms of 28% on the up and through the highest tax bracket, and then every marginal dollar thereafter is 39.6 under the old law and 37% under the new law. One thing I want to point out that's not on the schedule is that the capital gains rates did not change under the new tax reform law. However, there are 3 tax brackets. There's 0, 15, and 20. The 0% tax bracket actually goes from 0 to 78,950 in taxable income, where the 15% tax bracket starts, and then all the way through 488,000 is where the 20% tax bracket starts. So from a planning perspective, people should make note of the fact that they won't necessarily be in the 20% long-term capital gains rate until they reach a much higher level of taxable income. Looking at those 2 tables don't really tell the whole, give you the whole picture. So I drew up another table, and I wanted to share with you the comparison of what the highest tax bracket would look like under both the old law and the new law for different types of income. And if you draw your attention to the wages or the self-employed income column, the first column, you'll see that the highest combined rate for 2019 is 39.35 rather, and the old rate was 43.15. That factored in the phase out for miscellaneous itemized deductions. So the 3.8%, which is the rate reduction for those wage earners, the highest tax brackets, is really comprised of 2 different benefits. One is the 2.6% benefit between the 37 and the 39.6 rate, and the 1.2% benefit of the 3% miscellaneous itemized deduction at the highest rate. That's a combined 3.8% tax rate reduction. I want to share with you some of the other changes that took place for 2018 and 19 under the tax reform, and that would be the standard deduction, which, as you all know, has increased for married individuals from what it was in 2017 to 12.2 single and 24.4 individual. Also, personal exemptions were eliminated and suspended, and higher child tax credits were created in lieu of the personal dependent exemption. An interesting note, in 2017, when tax reform was being passed, the Joint Committee on Taxation estimated that 88% of all households in the United States will be eligible for the standard deduction, leaving only 12% eligible to itemize their deduction. For those that continued to itemize their deductions, there were significant reductions that were put in place under tax reform. The first, and probably the most relevant for many of our Northeast clients, is the limit on state and local and real estate taxes that are now capped at $10,000. There are other changes that were made, not as quite as significant as that, but if you go to the next slide, you'll see that the miscellaneous itemized deductions subject to the 2% floor were the other big change in tax reform that impacted many of our high net worth clients. And what we're talking about here is the investment advisory fees and the related investment deductions, unreimbursed employee business expenses, tax preparation, and other related professional fees are no longer deductible under miscellaneous itemized deductions. Another change that was made was under charitable donations, although it was really just a minor change. I think it was just to appease some of the taxpayers to increase the maximum on cash contributions from 50% to 60% of AGI. Note that to the extent that you give more than that 60%, both on cash and other securities, that the excess can be carried forward 5 years after the year in which the deduction takes place. Another major change, which I think impacted most Americans, is the fact that the AMT was retained. Everybody thought that it might be eliminated. It was for corporate income tax, but it was retained with higher exclusions and higher phase outs. That's not to say that everybody is no longer subject to the AMT. I've found that many of my clients still have AMT concerns, especially if they have adjustments to AMT, such as private activity bond interest or depreciation or passive activity add backs. And those executives who may have incentive stock options are all subject to AMT depending on the level of those add backs for AMT purposes. Another list of some revenue raisers that the government had made as part of tax reform, which I think impacts many people. And the first one on my list is kind of interesting. Alimony you wouldn't consider as a revenue raiser because typically alimony is deductible by one and taxable by the other. But there were statistics that showed that most people who received alimony never reported their alimony income, and obviously the ones who paid the alimony deducted it. So in order to cure that mismatch, the government decided that they were going to just make it non-deductible and non-taxable for individuals. Moving expenses were removed. Like-kind exchanges are now only limited to real estate as opposed to other property. The unwinding of a Roth IRA conversion up to the date of filing of your tax return was eliminated. And entertainment expenses are no longer deductible, at least to the extent of 50%. Entertainment, pure entertainment, but business meals are still deductible up to 50%. And last but not least, the individual mandate of the Affordable Care Act was repealed, effective 1/1/19.
Yeah, we can just add them all together.
So Mike had already walked us through the QOZ and the QOF provisions of the new law, both taxpayer friendly but complex. Let's talk about another revenue raiser, also complex. This is called the the excess business loss rules. What is the excess business loss rule? This is a code section 461 for those who are familiar with the code. We've had very little guidance from the IRS. We've got the form and we've got some IRS notices, but for the most part, no regulations have been issued. And this is essentially a limitation on losses for non-corporate taxpayers. I think what the IRS was trying to accomplish here, or Congress was trying to accomplish here, was to make it so that taxpayers who had business losses couldn't use those losses to offset against other income. There is an ordering rule, which means that this work is that to the extent you have non-business losses after applying all your other limitations, such as at-risk and passive activity losses, to the extent you end up still with a net operating with a loss after that period of time, then you would be able to you'd be limited to the $510,000, and the excess would be carried over to the following year as a net operating loss, and then further subject to net operating loss limits in the following year if you didn't have enough income to absorb that loss. Now that we've had an opportunity to go through some of a full year's tax season and the complexity and the mechanics of the new law, there's a couple of observations I wanted to make. One is the loss of the state and local tax and the 2% miscellaneous itemized deductions for those clients who are in a high tax state really countered almost completely the benefit of the lower ordinary rates that I pointed out on the tables. Another area that I thought was interesting is that the net investment income tax of 3.8% on interest, dividends, and long-term capital gain and on capital gains essentially was effectively increased due to the loss of the 2% floor and the state and local deductions, because those previously were allowable as a deduction against those 3.8% income items. And then last but not least, depending on the state that you live in, your state income tax could have increased if your state followed the federal income tax rules with itemized deductions. Some states like New York have decoupled from federal tax reform. So we actually find it, unless your income is so high that your itemized deductions get phased out, we find it important to also guide the clients on what the rules were prior to 2017 to take advantage of those deductions. So let's talk about traditional year-end planning now that we've gone through the rules that have changed from 2017 into the 18 and 19 tax years. Typical planning is to defer income and accelerate deductions, especially if your tax rate is not changing from one year to the next. We always recommend that our clients harvest capital losses to offset their gains. And conversely, to the extent you've got a capital loss carry forward, you want to take advantage of those losses and use the gains so that you can pay no tax and assist in restructuring your portfolio for rebalancing purposes. I pointed out the zero capital gains rates. If you're eligible, if your income is low, or if you need to take deductions in order to get to those levels, you should take advantage of the low capital gains rates, the low or zero rates. Always want to shift assets and income to others in lower tax brackets. That's a very easy tax planning. Obviously, it involves giving up those assets, but there's clearly other ways to do that. And then, the typical standard income deferral techniques I've listed here. Those techniques, are dependent on whether or not you have the ability to have stock options and retirement plans and sole proprietorships, but I won't go through the details there. And last but not least, I find this is a very important fact. Most people don't look at their prior year tax returns to determine what kind of loss carry forwards they may have, which would be eligible for use in the current year. So whether you have an NOL, a foreign tax credit, a passive activity loss, suspended loss, a capital loss carry forward, or investment interest expense carry forward, it's important to review your prior year's returns to take advantage of the deductions or income that you could be using in the current year to offset those losses that you didn't utilize. Some ideas on maximizing deductions. Again, if you're a closely held business or you have a Schedule C, it's pretty straightforward. You can accelerate deductions. But for a wage earner, that's typically you're unable to do that. So you're left with only a few other items. Aside from your itemized deductions, you can fund your deductible IRAs. You can fund your 401k even now if you haven't taken advantage of the full amount, if your employer allows it. You can utilize your flexible spending account up until the end of the year, if not longer, depending on your plan. And then you have until the due date of your return to fund a health savings account if you haven't already maximized that. For self-employed individuals, I would say that probably the biggest bang for your buck would be the funding of retirement plans where applicable. I know that Gretel already mentioned taking bonus depreciation. That's obviously something that should be considered. The next page, this slide really just lays out what the retirement plan contribution limits are for both 2019 and 2020. The point I wanted to make here is that all the amounts are indexed for inflation. So, to the extent you take advantage of them, they will be increasing from year to year. So what's left? I think what's left on the itemized deduction that I haven't really given a lot of attention to just now is charitable planning. And while you don't necessarily, not everybody has the charitable intent, those who do can take advantage of these charitable planning techniques and rules. The first technique that I wanted to mention is the bunching technique, where if you're not able to exceed the standard deduction in any one year, you can bunch those deductions to every other year. A useful tool to do that would be a donor advised fund. A donor advised fund is one where you can contribute the money today, but you don't necessarily have to dole it out to a charity in a future year. So that gives you the ability to accelerate those deductions into the year that you want them to be in. Another very important feature of charitable planning is you try not to give cash. I mean, cash is very easy to give, but if you have appreciated securities in your account, you want to take advantage of avoiding the tax on the long-term capital gain. It needs to be long-term in order for you to get a fair market value deduction. And to the extent you have a security that you want to keep, let's say you don't want to give away the Apple stock, you could give it away and then you could just go out and buy it if you've got the cash, and you could purchase it and have a higher tax basis. So charitable deductions, I think, is one of the major focuses of planners going forward, and for our clients who have that charitable intent. Another thing I just mentioned, if you are planning on making charitable gifts before the end of the year, that your check needs to be postmarked and your credit card needs to be charged by December 31st. And if you plan on attending that charitable gala before the year end, just a reminder, your raffle tickets are never deductible. and maybe the win could be taxable. The auction purchases are only deductible to the extent that the goods that you're, that the money that you give exceeds the fair market value of the goods that you received. And last but not least, the value of your services, the time and effort and the sweat equity that you put into your charity is not a tax deduction. For those clients and taxpayers who are inclined, there's a lot of sophisticated charitable planning alternatives. I've given you a list of them here. I'm not going to go through all of them, but I just want to say that if you do have an interest in using a donor advised fund or a private foundation or other types of charitable planning vehicles, please reach out to your MBAF representative if you want to learn more. Okay, some more traditional planning strategies. I'll just focus on one or two here that I think are important given our time constraint. Number one, if you find yourself in a position where you haven't paid in all your estimated tax payments and you're potentially subject to a penalty for underpayment, you can still take a distribution from your IRA and replace those monies within 60 days to satisfy your withholding obligation. So what that really means is you could withhold all of your IRA distribution to your federal and or state governments, and that's deemed to be withholding tax for purposes of estimated tax payments, and it's considered paid in and proportionately throughout the year. If you are a business owner and a small business or even an individual who sits on boards of companies, you can consider defined benefit plans. However, just note that you must have a plan in place before the end of the year. Otherwise, you won't be able to take a deduction in the current tax year. And last but not least, on the retirement planning side, there is an act that was legislation that was passed overwhelmingly in the House in May 2019. So regardless of the fact that it was a Democratic House, it passed this bill, and there's every expectation that the Senate will pass this bill in the future. And the key provisions here are that there are effectively elimination of all the stretch IRA planning structures that we've been using for forever, and it would make a 10-year payout on all non-spousal IRA distributions.
So Gary, before jumping into the estate and trust piece, going back to the slide that compared the 2017 individual rates to the 2019 rates, as Mike mentioned before, the corporate rates were reduced from 35% to a flat 21%, which in effect provided for a 14% reduction in the top corporate rate. That 14% difference divided by 35 results in a 40% reduction. But when you look at that slide, it looks like there was only about a 9% reduction to the top individual ordinary rate. And so it gives the impression that Congress was looking out for corporations more than individuals.
And that's true, Emilio, on its face. Corporations appear to have benefited more than individuals from tax reform. In fact, depending on your personal situation, your taxes could have actually gone up, depending on whether or not you're in a high tax state. But keep in mind that corporations and their shareholders are still subject to double tax in that dividends paid by the corps are not deductible, but still subject to a 23.8% tax rate at the individual level. So the effective rate for a corporation and its shareholders is 40% overall.
Thanks, Gary.
Now that we've covered the income tax side of things, let's focus on estates and trusts. So we know that there was a major change as of effective 1/1/18, the major change being that the lifetime exemption for estates and gift increased and almost doubled. The numbers back then were significant, and even today, 2019, a single individual has an $11.4 million lifetime exemption that they can utilize without paying any estate tax. So in 2020, that goes up to $11,580,000, which is an actual $180,000 increase in 2020. So for married individuals, we're talking about 22.8 and 23.16, which is a $360,000 change from one year to the next. Now, mind you, this exemption is increased and reverts back on December 31st, 2025, back to $5.6 million. So there's been some discussion. Obviously, the law itself mentioned that there should not be a clawback of this if a taxpayer were to use their exemption between now and 2025 and they were to die after it reverted back to the $5.6 million in 2025, what would happen? And the good news is that just recently the IRS provided us with their final regulations, which affirmed the fact that both the lifetime exemption, if used before 2025, and the deceased spouse unused exemption, if you were to die before that and transfer your exemption to your deceased spouse, both would still be eligible and would be calculated as part of your estate, but not reduced back to $5.6 million. On the trust, there really weren't that many changes. For the most part, a lot of the individual provisions that we talked about already, for example, the qualified business income deduction and the state and local real estate tax limit, and the 2% deductions were really also limited at the trust level. So, aside from the fact that trusts have a very, very compressed tax rate schedule and they're in the highest bracket at $12,750, they kind of act like an individual. There is one exception with regard to the 2% deductions, and that is that any expenses incurred at a trust that would otherwise only be deductible at the trust level. If they were held by an individual, they wouldn't be deductible at all. Would be trustee fees and trust tax preparation fees and expenses incurred in connection with distributions are all still deductible at the trust level. So let's talk about some observations, things that you should be thinking about now that we know that there is there is no clawback. First and foremost, if your plan hasn't been reviewed since before tax reform, I would encourage everybody to review your estate plan, no matter what your net worth. Obviously, if the higher exemptions were helpful to you now, but it reverts back to $5.6 million, and you would be subject to estate tax, that's worthy of doing some planning now. Let's see. This is really a unique opportunity for many of our clients who do have, large estates. And, so most of those planning techniques that we've used, back in 2012 and continue to use, such as GRATs and family limited partnerships and intentionally defective grantor trusts are very important wealth plan transfer strategies. And I would encourage everybody to take advantage of what the government is providing in terms of the non-clawback. If you live in a state that has decoupled from the federal law, these numbers are completely different. So, New York and Connecticut and other states who still have an estate tax are potentially much lower, even lower than the $5.6 million, and it's definitely worth working with your planners in developing a plan to avoid and taking that money off the table and avoiding paying tax at the state level. Last but not least, I wanted to mention the real true benefit of the annual exclusion gifting, which is $15,000 for both 2019 and 2020. Let's just take an example. Let's say you have 10 family members, grandchildren, children, maybe siblings, and you want to provide them with some annual gifts to help support their lifestyle. That's $15,000 per individual. If you're married, you can give $30,000 if you make a joint gift with your spouse. So that's $300,000. So clearly, if you can make an annual gift of, in my example, of $300,000 to your family, that would be a significant estate tax reduction at the end of the day, because not only is that gift not subject to the lifetime exemption, but it's also all the appreciation on that is not deductible. But the one thing I'll mention that I think is really important is that you need to talk to your beneficiaries. If you are making annual exclusion gifts, you need to find out what they're using that money for. If they're using that money to pay their medical bills or their education costs, you'd be better served in paying those expenses directly on their behalf, and continue to give them gifts as well. because direct medical payments and education payments paid directly to an education is not a gift. And last but not least, we want to talk about leverage, but we don't have a lot of time to do that. So we're just going to mention that, the simplest way to make a gift is to make it through cash or a forgiveness of a loan. And to the extent you have the time and the wherewithal to make gifts on a leverage basis, you consider leverage. Back to you, Emilio.
Wow, Gary, thank you. That was a heavy lift. Thanks for covering all that information. We're going to launch our third polling question now. I or my clients have made updates to our estate tax plan since 2012. Yes or no? So we'll give a couple minutes. All right. A couple more seconds. And the polls are closed. And about 59% yes, and the rest no. Mike, we have about 15 minutes left before going to Q&A. I know nobody boils down complex international tax issues faster than anybody. So Mike, turn it over to you.
Thank you, Emilio. I'm going to go over some international tax concepts and updates. So in the international tax world, prior to the Tax Cuts and Jobs Act, we had a system of taxation that allowed deferral of income that was earned outside of the United States. Basically, companies that were set up outside of the United States, foreign corporations that operated outside the United States, the income may have been taxed in the jurisdiction that they were doing business in, but it was not taxed in the U.S. until that income was repatriated via dividends, compensation, or just brought into the United States. We always had the concept of subpart F income, and subpart F income is generally income that is taxed in the U.S., whether distributed or not. And as an example, if I were to set up a company in the Cayman Islands and put $1 million in the company and invest it in stocks, bonds, certificates of deposits, whatever income that company earned would have been subject to tax here in the U.S., whether distributed or not. And not only that, the company could have been considered also a passive foreign investment company, a PIFIC, which would also be subject to tax in the U.S. at higher rates. But when President Trump took office, he did see that there were a lot of companies outside of the United States that had millions and billions of dollars, actually, of income that was earned and never taxed. One prime example of that, Apple. Apple had major income earned outside of the U.S. Apple set up factories in Ireland. Ireland gave them a tax holiday, even though the tax holiday in Ireland was 14%. Since Apple is Apple, they were able to negotiate a lower tax rate. So basically, their effective tax rate on their worldwide income, including the United States, was in the teens. Well, so part of the tax reform enacted Code Section 965, which is a transition tax to bring those worldwide earnings, tax those worldwide earnings on a one-time basis. The tax basically became a tax on the earnings that were earned outside of the United States prior to December 31st, 2017. That tax was approximately between 15 and 17%. For some clients, they really felt that this was a gift, because otherwise, at some point in time, that income would have been repatriated and taxed at a 35% tax rate. So a 15 or 17% tax rate is much lower. In addition to that, the government gave them an 8-year period to be able to pay that to pay that tax. So that was a one-time tax to repatriate foreign earnings that was done in 2017, 2018. In addition to that, on a going forward basis, a new concept was created, which is the Global Intangible Low Taxed Income, which we call GILTI. And this GILTI tax applies to foreign corporations that are owned by U.S. people on an annual basis. The GILTI tax basically is computed The guilty tax is a misnomer because it really applies to most income from corporations that are controlled by U.S. people, and it is not limited to just intangible low taxed income, even though that basically would have been the concept. The guilty tax is basically the ordinary income of active controlled foreign corporations that they are allowed to take a deduction for 10% of the net tax value of the corporate fixed assets. So if you have a company that has a lot of property, plant, and equipment outside of the United States, they may not be subject to any guilty tax because they may not have any guilty income associated with it. Companies that do have a lot of income and not a lot of plant and equipment could be subject to it. The income, if the company is owned, the foreign company is owned by a domestic corporation, that basically is taxed at a 10.5% rate. 10.5% rate because it's at the 21% tax, and you're allowed a deduction of 50%, so that's how it becomes to 10.5%. If the company were to be owned by an individual, it would be subject to a 37% rate. However, there is a planning opportunity if the foreign company is owned by an individual to do what we call a 962 election. It's a code section 962, which basically treats an individual as a domestic corporation with regards to the earnings from the controlled foreign corporation. This avails the individual to the lower tax rate on the guilty income and also utilization of the foreign tax credit. These rules are important to keep track of, and we've been very conscientious in looking at this for all our clients. I remember back in 2017 when the law passed. I think it passed around December 20th or December 21st. One of my colleagues called me while I was trying to be on vacation and said, "Mike, Houston, we have a problem. We have the new transition tax, and there is a way to defer the payment of the transition tax by interposing an S corporation in between." So we had 8 days basically to call most of our clients that were dealing in the international area, explain the situation to them. A lot of them said, "I don't understand why I have to pay tax on this." Well, there's a change in tax law, and that's why you have to pay tax on this. But we got it done. So for some of them, we were able to accomplish a longer deferral period. Others decided to go ahead and do pay the tax over an 8-year period. Moving on to the tax reporting, that is very important these days in the international tax area, of the international tax forms. We have many. The FBAR that used to be filed by June 30th on a form now has become the Form 114. It's a FinCEN form, and it is electronically filed. In the old days, if the forms were due on June 30th, but if we filed it late, nobody cared, no penalties were imposed. Now we dare not file any of these forms late because the IRS computers have been programmed to generate notices and penalties anytime if one of these forms are filed 1 or 2 days late. The Form 8938 was a new form that was established 3 or 4 years ago to report foreign financial assets. Any U.S. person with any foreign financial assets needs to file that. The penalties for non-willful violation may be up to $12,459. It used to be $10,000 per violation. They increased it because of cost of living. Very smart of the IRS. And if the violation is willful, the penalty may be up to $124,588 or 50% of the amount in the account in the time of violation. That is for a willful violation, failure to file an FBAR form. There are criminal penalties also associated with this for willful violation, which could be up to $250,000 or even imprisonment for not more than 5 years, or both. The penalty for failure to file the Form 8938, the statement of specified foreign financial assets, could be from $10,000 to $50,000. Now, other forms that are required to be filed by U.S. citizens owning foreign corporations and foreign entities The Form 5471 is required to report the ownership of foreign corporations. This form was revised last year, and it became a much larger form with more schedules or more complicated. In that form, we're required to report the financial statement and income statement of the companies, convert them from the accounting method that they use in their home country to U.S. GAAP, all of course reported in US dollars, and you do also report the functional currency of the country. So it is a complicated form, and it has become more complicated even after last year. Form 8865 is the equivalent of the 5471, but that applies to foreign partnerships. Form 8858 is required to report the ownership of foreign disregarded entities. As part of tax planning these days, we do a lot of what we call a check the box election. This is an election to treat certain entities as disregarded for U.S. tax purposes. It's a positive planning technique, which in those cases, yes, we have to report all the income of the foreign entity in the year earned, but at the same time, if you're paying tax in the jurisdiction that you're doing business outside of the United States, we're able to claim a foreign tax credit for it. It avoids foreign tax double taxation. Form 5472 is to report transactions between related parties and foreign corporations. Now, starting in 2017, the Form 5472 now has to be filed to report related party transactions between U.S. LLCs that have a foreign owner, a sole foreign owner. A lot of foreign companies and foreign owners have been using U.S. LLCs, which are disregarded for income tax purposes, to have bank accounts and investments in the United States. Some of these investments may not be subject to tax at all, but now the U.S. government wants to know the existence of these entities and what are the transactions that they have. So these LLCs, even though they have no taxable income in the U.S. and are not paying tax to the U.S., do have to report, if they have a foreign owner, the transactions between the foreign owner and the disregarded LLC. Failure to file these forms timely now carry a penalty of $25,000. In the past, it used to be $10,000. And again, the IRS has done a tremendous job in programming their computers so that anytime that one of these forms is filed late, you are guaranteed to receive a notice assessing a penalty. In the foreign trust area, we have forms 3520A and forms 3520. The form 3520A is required to be filed to report U.S. individuals who are deemed to be owners of a foreign trust or a foreign grantor trust. In that form, we do report the income statement and balance sheet of the entity, and with that form, you file a form 3520 that is reporting transactions with foreign trust, ownership of foreign grantor trust, and distributions from the trust, and also to report gifts received by a U.S. person from a foreign individual. There is a requirement that any U.S. persons can receive gifts of unlimited amounts from foreign persons, and they're not subject to gift tax, or the receipt of it not subject to income tax. However, a U.S. person receiving a gift from a foreign person in excess of $100,000 is required to file the Form 3520 and report in Part 4 the amount of the gift, the date of the gift, and file it timely with a personal tax return. Failure to file this form carries a big penalty. The Form 3520A, if it's filed late, will subject the U.S. owner to an initial penalty up to the greater of $10,000 or 5% of the gross value of the trust assets. The penalty may also be assessed if you filed an incomplete form or an incorrect form. Now, on the Form 3520, there's a minimum penalty of $10,000 if it's filed late, but it can be up to 35% of the gross value of the unreported contributions to the trust or distribution from the trust. The penalty for not reporting a gift or bequest could be up to 25% of the value of the gift or bequest. Now, penalties, there are provisions in the law and the regulation that they may be abated for reasonable cause for the late filing or incomplete or incorrect filing. The IRS has gotten more stringent in abating penalties. Usually, if there is a only one omission, this is the first time that one of these forms has been filed late, um, the IRS may and does sometimes, most of the time, go ahead and abate the penalty. Sometimes we've gotten the payment, the penalty abated with our first response to them. Other times it has taken several instances to get the penalties abated. And the most important thing is file all these forms timely. Get together with your accountants, give them the correct information, and file the forms timely. Do not get into a situation that you're requesting abatement of penalties because you may not get it. And these penalties have become very large, very serious, and they are assessed immediately. So Emilio, with that, I'll turn it back to you.
Okay, thank you, Mike. We have about 2 minutes left for questions. I do want to get to a couple of them real quick. Gary, there was a question posted on whether distributions from RMD, the 100,000 distributions from RMDs, can be made to a private foundation. Can you address that real quick?
Yes, Emilio. Actually, I think in order for the QCD to be eligible, it needs to be donated to a charitable organization under Section 170B1A, and I don't believe that a private foundation falls under that code section. However, having said that, I wanted to mention, I did not mention that in my presentation, that there is a $100,000 qualified charitable deduction that is available. If you want to take a required minimum distribution, you can avoid reporting that income and make the payment directly to the trustee of a qualified charity under Section 170B1A, and that would be eligible for a deduction and qualify as RMD.
Okay, Mike, a question for you. Should inherited property that is located outside of the U.S. be reported on Form 8938?
Okay, there's two reporting things that need to be done here. One, if the gift was more, if the property inherited was more than $100,000, it has to be reported on Form 3520, Part 4. That's one thing. If the property is real estate, and that's what was inherited, then it is not a foreign financial asset. It doesn't need to be reported on Form 8938. However, if the property was inside of a foreign corporation, then it does become a foreign financial asset, and that foreign financial asset has to be reported on the Form 8938.
Oh, and I thought that was going to be an easy one. Gretel, quick one for you, and then we'll wrap it up. Is our Schedule C subject to the interest expense limitation rules under 163J?
Yes, Emilio. Schedule Cs are subject to the same rules as if it was in a partnership or an S Corp or any other entity. Now, the difference is if you have a Schedule C, there's a very good chance that is not owned by limited investors or entrepreneurs, right? So as long as the Schedule C reports gross receipts of less than 26 million, there's a very good chance that it will be eligible for the small business exception. However, you have instances like day traders and securities, and you can easily exceed that $26 million threshold. So yes, it does need to be considered for purposes of 163J.
Okay, thank you. If we didn't get to your questions, we'll try to post some the answers to you individually. And with that, I'd like to thank everybody for joining us today. A special thank you to my partners, Mike, Gretel, and Gary. Thank you all, and please provide us your feedback. Thanks again. Goodbye.